Everybody, welcome back to Climate Transformed and our two-day deep dive into the voluntary carbon markets. Can't have a conversation about VCM without the topic of transparency. And frankly, the topic of transparency is probably one of those things that will sort of permeate effectively every conversation that we'll have over the course of the next couple of days. But this is our deep dive into the actual specific topic of transparency. And I just wanted to introduce you to a group of people who do come at this from a very different perspective, and this will be a very well-rounded conversation. Paula Vanlaningham is the head of carbon at S&P Platts. Marcelo Labre is the CEO of Viridios AI. I'll allow them all to introduce themselves and their companies in just a second. Nico Girod is one of the co-founders of Clearblue Markets and is in Toronto. Nico, is that correct?
Amsterdam today.
Amsterdam today. There you go. I got that more wrong. And Raúl Rosales from Imperial College, who's going to, in a moment, do a dive into accounting standards, which is one of the sort of the factors that you don't really talk a lot about when you think about transparency. Everyone, questions at the bottom of the screen. Paula, I'm going to start with you. Because you're at the top of my screen, so I'm going to pick on you first. So, can you do me a favour and sort of set the stage for us in terms of why transparency is an issue in the voluntary carbon markets, and why is fixing transparency so important to the future viability of the ecosystem?
Absolutely. I can, kick things off for our panel today. Thank you so much, Paul, for having me. I think transparency is a really complicated question in the voluntary carbon markets, in part because people mean different things a little when they talk about transparency. There are different ways that you can look at it. So one of the ways that people talk about transparency in the voluntary carbon markets is around this idea of knowing exactly what is trading where and when. People also talk about sort of overall carbon credits and transparency of quality and when they talk about the voluntary carbon market. And of course, there's this real large question about what is the transparency of price. And that's been a particular challenge, I think, throughout the history of the voluntary carbon markets. All of those have been challenges throughout the history of the voluntary carbon markets for sort of different reasons, in part because most of the time these carbon credits have traded in a very opaque, over-the-counter way. And it's not really been clear, even to participants in those spaces, exactly what the price is and exactly what the individual attributes of the different types of credits are. So I think a lot of what the most recent initiatives that you've sort of seen coming out of the voluntary carbon space has been around bringing transparency to those markets in all of those different respects. What we've been doing at S&P Global Platts is really trying to bring transparency to price, and specifically transparency through pricing benchmarks, which is a little bit of a different approach than just bringing transparency to this is what every single thing has possibly traded at. And that's sort of designed to create the system that will allow markets to have reference points that will give them the opportunity to scale up effectively, which is going to be, I think, a big key part of whether or not they are able to be successful in the way that people, I think, and everyone perhaps dialing into this call is hoping that they will be moving forward.
Got it. Marcelo, that's probably a nice little segue to talk a little bit about the relationship that you have with S&P Platts in regards to, I think it's seven benchmarks that you've worked on in collaboration with S&P. Can you talk a little bit about the role of benchmarking as an anchor to creating price transparency? And we'll just to fill you in, like the first three panels we've had today have all spoken about this enormous disparity in the price of carbon globally, right? A ton of carbon here is not the same price as a ton of carbon there. Talk a little bit about how benchmarking can go to fix some of those problems by creating this standardization which many people desire.
Sure, Paul. So I just wanted to address one thing quickly, right? So benchmarking, of course, it's extremely important in every financial market. And I'd like to generalize the VCM as another one of the many financial markets that have evolved over the years, right? Over the decades. So every time a financial market evolves, there needs to be, as Paula mentioned very clearly, there needs to be a point of reference. There needs to be benchmarks for people, for participants to know at what stage, at what point level the market is at any point in time. And obviously points of reference so that, asset managers, bankers, anyone who is deploying capital into this market can also assess risk and make financial projections. So it's very important to have a point of reference. And as Paula mentioned, Platts does produces, several assessments, right, on carbon prices. But then in partnership with Viridios AI, we also produce the 7 indices, which, you can take those as benchmarks as well, points of references on specific project types. So we have today like soil carbon, household devices, reforestation, afforestation, conservation of forests like REDD+, and more recently we added blue carbon. Okay, but having said that, Paul, and I wanted to kickstart a little bit of the controversy, right? And I'm sure you're going to go in that direction at some point, is that, although every financial market requires these benchmarks and these points of reference, the voluntary carbon market is not a commodity where a single point of reference, standardized price is going to take it. It's going to make the cut. Okay, and you mentioned something about price of carbon is different in different regions for different project types and so on and so forth. Of course, the cost curve of carbon is different depending on what type of project you're dealing with, depending on what country implementing that. And there are different demand points and demand curves, right? Some investors and some corporates are more averse to certain regions, while others are not. So it's a huge amount of complexity that the voluntary carbon market has in place. And if you look under the hood, if you really look at carbon credits and carbon projects, it resembles more a single name market, like credit markets, rather than a commodity market where you have a single price for everything. Okay, even in credit markets, we do have benchmarks, we do have indices, we do have points of reference. We have to have that, but that's not what dictates the whole market overall. So the prices of different credit instruments with its own idiosyncrasies will dictate prices. And the same thing I see happening with the VCM at the moment and going forward.
Got it. Nico, I'm going to get you to take this because it's sort of gone to the. I think we got to the crux of my thoughts very, very early. So I agree with Marcelo wholeheartedly. This notion of that these are not commodity markets. So you shouldn't compare carbon to copper or coal or to iron ore. That these are like credit markets. That these are idiosyncratic instruments. And the one common theme amongst credit markets is there is an absence of futures markets. There are some benchmarks, but they're loosely used. It's nowhere near like you have with benchmarks with other assets. Assume that's correct for a second. Is that the sort of thing that can hold back the financialization and standardization of VCM? Because if these products are simply a summation of a slew of idiosyncratic assets, right, doesn't that hold back the financialization of voluntary credits? And as such, isn't that an inhibitor to scale?
Yeah, that's a great question, Paul. I'll talk about my experience as well in our company, but also in the past working in the ETS, the European scheme, using CRs. Back then there was a future that was listed by ICE, and that was pretty liquid. What happens with those futures when you try to commoditize carbon is that you essentially get the lowest common denominator selling into these futures. So that does serve like some kind of a floor as well to the market. It is also an important price signal. But now going forward and looking at where we are today, so there is a main future that has been listed a year ago now by CME. There is some liquidity. At the same time, you can see that those markets are not very liquid yet. You probably have an open interest of around 15 million tons on those main contracts in GO and NGO on CME today, while the market used 160 million credits last year. So it is a signal. It does help the market. At the same time, if you look at the forward curve, it's really pricing a very high increase in the future years. which is probably not what you see in the OTC market. So there's also a lot of differences between the futures market that is also open to, like, to be honest, to be like manipulated, I would say, because there's not that much liquidity. And on the other side, you have the OTC market that is more representative, but at the same time, less transparent. So it does serve a purpose. I think it's mostly used also by financial investors, some of them trying to use those contracts for hedging purposes. And there it makes a lot of sense. At the same time, as an end buyer, as a buyer, you probably don't want to get delivered into those contracts and probably you want to roll those hedging position. So that's kind of our view is, yes, you have a financial market that is very useful and will be useful to scale the market. At the same time, you need to not forget it's an OTC market, very specific to country, very specific to end buyers as well. And that's something to take into account. And then, looking forward, we do see a lot of more futures being listed, a lot more products being listed, and that might be also an issue for scaling, because that's going to probably create more confusion than anything else. So we're trying to keep track of all this information for our clients and see how that will evolve in the future. But definitely, you need to have a liquid future contract to help the market scale.
Got it. Paula, can you take that a little step further and just talk about are benchmarks essential to scale, right? Because again, we talk a lot about the growth of this market, but it's the growth rates look great because they're starting from such a low base, right? So, and you hear numbers getting thrown about all the time about a $300 billion market, by 2030. We're nowhere near that, right? We're nowhere near that, and we'll require extraordinary growth rates to get anywhere close to that. Is benchmarking an essential part of this scalability?
I would argue that yes. I would also actually probably disagree a little bit with some of the points that were raised earlier. I actually do think that this is a bit of a commodity. I think the question is whether you call it a commodity like gas or coal, where every unit looks the same, or you call it a commodity that, I know this isn't always the right comparison to make in environmental circles, or that it's more of a commodity like oil products, where different attributes have different non-zero impact on price. And those have historically been very possible to create benchmarks that are very usable and transparent across different attributes. So you see that a lot. For example, my background is actually in crude pricing. So I talk about it a lot. Many apologies given sort of the fact that we are all on the other side of this equation at the moment. But different attributes of crude cargoes don't look the same, and they have different potential product outputs, which can also affect value as well. And so you can really price those differentials, and they all price against major benchmarks. So in Europe, they price against Dated Brent, which of course is an S&P Global Platts assessment. They also price against Dubai and WTI WTI NYMEX in the US. So it's something that I think that has been pretty consistent across different commodities. In the emissions sort of voluntary carbon space, the way that we have set up a lot of our spot market price assessments is around sort of a similar concept. So we can control for different attributes and normalize for different attributes so that you can still get that OTC spot market benchmark that Nico is referring to that is extremely important for people. They don't necessarily want a lowest common delivery credit. Most buyers are very invested in the different attributes of the credits that they try and buy. I think that's become something that is really become even more apparent over the course of the last 6 months than it was necessarily even before, as more people have entered in this market and become more educated about what different attributes of credits mean. And so, you have that interest where people are looking specifically for certain types of Red Plus credits, or they're looking specifically for credits from specific geographies. And that is not price neutral necessarily. It frequently is not price neutral. And so what we have done is created a very sort of specific definition around benchmarking so that you can use that as a reference. And if you have a slight variation in what you're doing, you know that you can price it at a premium or discount relative to the pricing benchmark, the same way that you would with any other sort of commodity. And I think that that's sort of maybe the paradigm shift that we're looking at in voluntary carbon right now, is if it does go down that route, or if it tries very hard to sort of create this very commoditized aspect, which is what you typically see in something like an EU ETS compliance market, where again, it's very similar to gas, where every single unit looks identical. That's, to Marcelo's point, not really possible, I think, in the voluntary carbon markets. And so that's kind of where benchmarking can really play a key role, is being able to kind of take away that flat price risk that you would get by pricing everything on an outright price basis and just looking at it as a premium or a discount or par to something that is very similar but not exactly alike, because no voluntary carbon credit issued by different projects is exactly alike. And I think that we sort of have to accept that it's not going to commoditize the way that you would expect gas to. It's going to commoditize the way that you expect diesel cargoes to. And so I think that is going to be really critical to being able to scale that up. And potentially, while we have some futures contracts now, and we do work with sort of with both expansive on the spot basis and CME on the futures basis as well, there is potential room for other futures contracts, and some will succeed and some will fail. And to Nico's point, I think that the fact that there are so many right now is creating a little bit of confusion in the market, in the sense that there's just so many places to place your bets at the moment, and it's still a very small market. And that kind of raises this question about which comes first, the scaling up or the financialization. And the truth is that they have to grow kind of simultaneously for it to really truly be effective.
Got it. Now, Raúl, before we get into the topic of accounting, I just want to finish this a couple of points here. Marcelo, I take on board everything Paula said, and it's all incredibly sound logic in terms of the comparison to commodity markets versus credit markets. But I do think that there is one major point of differentiation, which I think is the developmental gains of offsets, which was one of the inherent characteristics of offset markets going forward. My fear is that these are going to get pushed to one side, particularly as with things like SEC disclosures and the like, and the movement from credits being something that's sort of handled out of the sustainability side of the business, where they take into account things like developmental gains, to the treasury side of business, where they're just going to turn around and say, we disclosed X to the SEC because of disclosure requirements. We just need to find Y tons of carbon to offset that. And that's just, we'll find them in the cheapest possible ways that we can. Can you talk a little bit about about how benchmarking takes into account development gains? And is it inevitable that future benchmarks are going to be nothing more than focus on nothing more than carbon attributes?
Yeah, well, I'll give an example, which is our indices, right? In partnership with Platts, right? Our indices actually have differentiation on the SDG contribution of projects, and you see price differentiation due to the more SDGs being contributed to projects. So, as such, benchmarks can take that into account by aggregating, because in the end of the day, benchmarks are aggregation of data, right? So if you aggregate data in a way that differentiates the developmental contributions of projects and prices coming from those projects, you are able to actually project, right, the pricing signals that are coming from those aspects. And why are there? The question is, why are there price signals coming from developmental items like co-benefits, SDGs, and so on and so forth? And that's how the market or how this space has evolved. So I've been, I was quite active in the Kyoto days, right, with CBM and the UETS and so on, when this market was truly a commoditized market, right? So it was much more commoditized market than anything. And there was no absolutely care about SDG or anything. There was no even such thought about co-benefits or things like that. It was all about carbon. And then fast forward to the future, to where we are now, you see VCM where the SDGs co-benefits are extremely important aspects, and you see all registries now starting to add SDGs to their databases and everything, right? Certifications, new certifications of SDGs, and so on and so forth. And where this is coming from, Paul, it's from the bottom up, right? It's from, and the whole VCM is coming from the bottom up, not from compliance, government regulation. It's coming from shareholders, stakeholders of corporates, demanding, the corporates actually buy carbon credits, for example, or invest in carbon projects that have more co-benefits than others, for example. So I don't think this is going away, regardless of regulation compliance markets. Yes, compliance markets will tend to force a commoditization, some form of commoditization of the market. but there will be a limit to it. The voluntary carbon markets will always be there because no compliance market can cover the whole gamut of emissions in the world, right? So that would be my position there. I don't think this is going to go away. This is going to just intensify because you see more and more corporates committing to net zero. You see more and more different groups and the whole global population, right, driven in that direction.
Sorry, Paula.
Yeah, I was just going to, I think, follow up a little bit on what Marcelo sort of articulated, which is that, I mean, I don't think that, I mean, I think that there is probably always going to be a two side to that market, right? You may have some buyers who are driving that kind of commoditized, any metric ton of carbon will do as long as it meets this minimum requirement. But you also very clearly have a market that is still very much committed to knowing all of the ins and outs of the project credits that they buy, including co-benefits, which are very clearly an attribute that people attribute a premium to or a discount. It's a big part of how the overall conversation has been going around quality. A huge part of that is focused on making sure that you do continue to have that developmental aspect and sort of fair transition component to a lot of this. That is absolutely not going to go away. And again, the way that we look at it, sort of, you know, as Marcelo said, with sort of that's a big part of why we developed the Viridios Platts indices the way that we did, is to be able to price those differentiations and co-benefits. And on our spot market assessments, it's something that we consider as well. So high co-benefit projects typically trade at a premium relative to low co-benefit projects. That's highlighted. And I think that as the market becomes larger and we have increasingly more data to work with, that's going to continue to differentiate itself even more clearly than it already is.
Got it. Sorry, Anna, just before I get into Raúl, Nico, you had a comment?
Yeah, no, just very quickly. I mean, at the end of the day, from what we see on our side, like the corporate or the company that comes to us will have a budget. So they'll have a price that they're thinking about and try to optimize around that price, you know. So yes, co-benefits are important. Yes, they'll try to get the best project they can. But if the budget is limited, then they'll need to find a way to, probably look at only the ton of CO2 rather than looking at the co-benefit. So from what we see, it does depend on the type of client. Some of them are only about the ton of CO2. Some others are really looking into the different attributes you can have and trying to get for the best quality, you know. And that takes us back to a quality discussion. I don't think we'll discuss that today, but it's also an important aspect here on making sure that we do have credits that deliver what they say they are doing, essentially.
Got it. Raúl. So we talk a lot when we have this conversation of transparency. There's price transparency, as Nico applied this. Are you actually getting what you're paying for? There's that level of transparency. Obviously, universal, globally accepted accounting standards is something that plays a role. I know this is something you've done a lot of work on. Can you take a couple of minutes and just walk us through sort of where we are in terms of a global adoption of accounting standards, and sort of a little bit about the work that you've done to get us to talk about that?
Okay, thank you, Paul. Well, I have to say first of all that transparency, liquidity, and pricing are the key three drivers of voluntary carbon markets to scale up these markets, and also to mobilize funds and also to mobilize institutional investors. No, I have to say where we are at the moment. So first of all, accountants, auditors, and users of financial statements expect right now a standardized system for carbon accounting measures and financial disclosure. So this will lead to transparency and integrity of voluntary carbon markets. The second point is that a level playing field for valuation and reporting of carbon offsets should be set up sooner rather than later. And I would like to highlight three main accounting questions for approaching this. The first one is, how should carbon credits be valued at the point of purchase, and when should they be reported in the income statement? The second question and third question related to the liability, how should the liability be valued over time, and when should it be reported in the income statement, and how should the liability be recorded? So that's very important. There are no responses to this right now. So, and the third point I would like to highlight is in this brief introduction is a representative carbon accounting system must be based on measurement, and it should be sound and consistent across treatment of transactions timely and incorporates high-quality data while capturing all the uncertainty. I mentioned all this kind of uncertainty because it will allow some risk management and the risking facilities afterwards. When we're talking about voluntary carbon markets, we are talking about carbon markets, but from a capital markets perspective, and that's the point. Well, just to say something positive as well, because there is a lack of regulation, which is astonishing right now. The International Financial Reporting Standard, the IFRS, advisory IFRS Foundation trustees, the past month of November, on the 3rd of November 2021, they announced the creation of a new standard setting board, which is the International Sustainability Standards Board. So I think this is a very, very good, a very important step, but this is only for the timing on the side of measurement. And on the side of reporting, nothing about the accounting. And but I would like to say something more. Where are we right now with the IFRS? What is the IFRS approach? Again, the IFRS does not explicitly address the accounting for greenhouse gas emission rights. Okay, and to be more specific, the International Accounting Standard, number 8, in the absence of this kind of regulation on the side of the IFRS that applies specifically to a transaction management, they say that the management must apply its judgment to specific transactions. And just to make the story short, how they deal with this kind of carbon offsets, mostly on the side of the box of intangible assets and inventories. However, they should be treated as financial instruments. We can talk about right now as well because this is the way forward to be treated as to be dealt with within as financial instruments and also taking into account the fair value. This is critical.
Got it. Related to that, there's an audience question, which I'll pass over to Nico. You can take this one if you wouldn't mind. One of the questions from the audience was about how do you actually put a price on co-benefit and STGs, right? So if you're thinking about if there's a basis up or down versus a benchmark based on STGs, how is that possible to even measure many of these intangible benefits?
Yeah, I mean, from my side, I'm a believer in markets, and so I believe that markets should price everything into a specific contract or product or project. What we do witness, so we do gather a lot of data on ourselves. We also have a partnership with OPIS, another pricing agency, and there what we do see is that projects with more SDGs do trade at a higher premium than project without SDGs. So it's you can clearly see that in the data. And then how is it really priced? At the end of the day, it's supply and demand. So each project would be very specific as well. Certain projects are purchased by certain buyers. If you have a large Silicon Valley company that really wants to buy a specific project, well, the premium can increase to infinite. It's a question of supply and demand at the end of the day. It's difficult to pinpoint and say this SDG has this value and how do you come to this value? It's difficult to set up because at the end of the day, it's about demand and supply. That's at least the way we see it. I see Marcelo as,
Paula?
Yeah, I mean, we agree as well. So at the end, it's about sort of where the market kind of values those things and in general, and it's not static. It's really important to stress, actually, that it's not static. These things change depending on how much is available at a certain amount of time. Of course, who is seeking what at different amounts of time as well. It's about sort of building that level of transparency in order to do that. I don't think anyone at this point can necessarily conclusively say that clean water will get you a 20-cent premium to a specific project. That's not really how it works. Typically, how it works is number of SDGs and baskets of SDGs. So if you are, for example, having a nature-based project, you would typically expect to have the nature-based SDGs kind of built into it, right? So life on land and life below water. There are carbon projects that don't have that, but they are very much they're sort of outside the norm. You sort of expect certain types of projects to have certain standards. So, with something like a Stoves project, you would expect it to sort of have no hunger attached to it, as well as probably clean and renewable energy. These are things that you just are built into sort of the fabric of the initial project. It's the additional benefits that are what brings that premium or discount relative to sort of the standard. And that, will vary depending on sort of what that project is. And again, it's not a static thing. It's something that will change with the market dynamics. And I think that it's important that whatever methodology or whatever benchmark you're using to do that is able to capture that dynamic as well. Because if you sort of like hard code it in, there's no way that you're going to continue to be up to date with the way the market is moving. And that's kind of to the point about sort of Nico's point, which is that it's a market mechanism. It's not really something that has a static built into it per se, but it's absolutely something where you would see premiums attached to projects that have higher co-benefits and particularly atypical benefits than the ones that are sort of like baked into the methodology of the project type.
Good, Marcelo.
Okay, Paul, just wanted to leverage a little bit of what Nico said there, which is, and Paul as well, which I completely agree. It's a market mechanism, right? The premium for SDGs, for co-benefits embedded into pricing. You can see that in the data itself. The question is, how do you extract that premium? How do you know what the premium is on average? Of course, there is a distribution. It's not a single number for every single project, right? But how do you extract that value, right? So that you can then play around with that. So in our PAI platform, just to give you an idea, we do that through AI because it's an extremely complex type of number, or let's say a set of numbers to get from. If you were like a single factor type of asset, you just put that on a spreadsheet, a bunch of data, and you'll be able to easily extract that. But when you involve project type, geography, standard, and a bunch of other things on the top of that, and 17 SDGs on top of that, it becomes extremely complex, and only really high technology can do that. And we do that through AI. And we are able actually to display very clearly SDG premium on project level through a platform. So that's now possible through AI to be able to extract and appreciate the SDG premium that comes from the data.
Got it. Nico, talk a little bit, will you, about the role of exchanges in terms of transparency. There's a natural assumption there about about price transparency naturally, but what role should exchanges have in ensuring the quality of the underlying assets that they are promoting?
So yeah, I think I'll go back a bit to the point I previously discussed, is that like the exchange and financial products have a important role to play. They're there to help hedgers, so people that want to cover their exposure in the future. They're also there to help developers to fix price on their projects. While on the physical market, well, it's very different. You're an end buyer, and you'll go and look for a specific project. And so you might use as a price reference what the exchange is. But at the end of the day, yeah, you'll look at the specific project. In certain cases, you can also see like extreme movements in exchanges. So when the contract was listed a year ago, we saw a lot of new buyers coming into the market while there weren't that many sellers. And so at some point, we actually saw that the future market was trading higher than most of the OTC product. While when the market came down, we saw this premium build again into the OTC credits. So there is a role, it's there. And sometimes it exaggerates a bit like price movements because speculators will go and push prices around. But at the same time, yeah, it should be used only as a reference, not as the only price signal to price a credit.
Got it. So everyone, a little book report for us all. Is blockchain for transparency standpoint A, a red herring, B, the holy grail, or C, something in the middle? Paula, you happen to be top left again, so I'll pick on you to start with.
No, that's fine. I have quite a few opinions on them. I'm not sure how many of them are official Platts opinions. So it's sort of, I think, one of those things where it really depends, I think, on how you use it. It's important to note as well that blockchain's a fairly energy intensive industry. So that's obviously should be a factor when you're dealing with kind of green components. Where I have always sort of seen, just personally, sort of the efficacy of blockchain as a mechanism has been less to do with carbon credits themselves than it has to do with the intricacies of international carbon accounting. Carbon accounting itself, obviously, I mean, to Raúl's point earlier, is something that I think needs to be standardized. It's a big question about sort of the overall, not even, people have questions about the integrity of carbon credits and the efficacy of them, but people have a lot of questions about how they're claimed as a big part of that. And a lot of that has to do with sort of the complications and mathematics around carbon accounting, which is very difficult to manage. And potentially something I would say that the blockchain has potentially quite a lot of opportunities and use cases there in a way that is perhaps somewhat different, but I guess time will tell. I am not a blockchain expert by any stretch of the imagination, and nor would I pretend to be, but that's always been the area where in this space where I see kind of the most potential use cases, international carbon accounting, more than specifically use cases within the VCM. But again, it's a market thing. So I may prove to be incredibly wrong on that front.
Raúl, I'm going to let you run with that pass that Paula just gave to you about carbon accounting and blockchain.
Before responding to that question, I would like to say something about the role of exchanges. I think there are two roles which are quite important. Firstly, trustworthy market infrastructure, because voluntary carbon markets are not regulated, and exchanges, they are regulated. So they provide this kind of trustworthy market infrastructure, which is very important. And the second thing, they provide liquidity. And we can have a look to the London Stock Exchange, for instance, with initiative in voluntary carbon markets for carbon credits listed funds, which is very important. And this liquidity is one of the drivers, as I mentioned at the beginning, to scale up voluntary carbon markets. And there are two exchanges in the world very active in this space. One is the Singapore Exchange, and the other one is the London Stock Exchange. So I'm turning to the carbon accounting, again, to address and to highlight that at the moment there is no specific accounting definition for carbon contracts in the accounting regulations, whether international or local. And that's one of the issues. The rationale for that is the lack of understanding, I have to say sometimes on the side of regulators and policymakers, on these investable assets and its financial instruments. And the other point is that there are other priorities for accounting regulatory bodies as well, instead of the carbon accounting markets. So again, there is no clear regulation on how to account for carbon assets. This is where we are at the moment. I mentioned before that they are with this kind of approach with intangible assets and inventories, which is not the capital markets approach, and this is not the more convenient for the players in the market. Is very painful from a regulatory capital point of view for financial institutions, and we can talk about that if you want as well.
Right. Well, I just want to hold that thought for just a quick second, if you wouldn't, Raúl, because I do want to get something which I think is, for me, is a pretty important sort of linkage here. And Marcel, I'll get you and Nico to talk about this if you wouldn't mind, which is on the importance of common carbon principles as a driver of transparency. So one of the complaints that we hear day in, day out is the level of complexity about offset markets in general. And we've interviewed David Antonioli for this, and David and I were joking after we spoke about after we did our interview, and so I asked him how big the file room was at Vera, because I can only think that it is literally millions and millions and millions of pages of documents just sort of stacked up in boxes everywhere. A simplified approach is, for me, essential to getting to that push towards transparency. How important are the common carbon principles to getting to that level of simplicity?
I'll start maybe. I would start on my side saying that, it does help large participants, investment banks, etc., to get more comfortable with the market. When we started hearing more about investment banks in voluntary markets 3 years ago, mostly 3 years ago, a lot of them didn't know what project to invest in, and were asking for some kind of additional stamp to help them, so they could pass their KYC internally. So it will help financing large financiers to get into those markets. At the same time, sometimes I wonder if we're not redoing things that are already done by Vera, for example. So Vera has its own criteria. It's not perfect, and the offset market is never is not perfect, and we are learning as it goes. However, they do have already their criteria. There's third parties verifying those projects. So sometimes I do wonder, even with these like rating agencies as well, if they're not like redoing all the work that Vera is doing. So shouldn't we just get comfortable with Vera and then assume that most of those projects are high quality enough? And yeah, so it's to me there's on a certain aspect it does help new people come into the market and be more comfortable with the market. At the same time, sometimes I wonder if we're not adding work for nothing here.
Got it. So then Paula.
Yeah. So Paul, I agree with Nico for sure. So if you think about core principles are basically another way to try to standardize, right, and create points of references so that people can know what they're dealing with, right, in the market. And you have a lot of that already in the registries, right, in the methodologies. You have a lot of that embedded there. And this is still evolving, right? So as Nico mentioned, they have rating agencies now evolving and coming up with different aspects of the projects as well. I'm a believer that it's going to be the market mechanisms that are going to force what's important in this mix of carbon core principles that's starting to emerge now. And that the right mechanism is eventually that to find its way through the certification, verification, monitoring process, and the registries, basically hosting and certifying this sort of this sort of aspect of the projects, right? As an information provider on our side, Viridios AI, part of our mission is actually to create transparency on the project level on a number of these items that come from the core principles as well. And we hear a lot of feedback from clients, and more we curate projects to make this available there. So there will be a role for people like us as well, like the information providers and everything. But in the end of the day, the right mechanism is through the market into the certification, monitoring, and verification process of the projects.
Paula.
I was just going to add a bit that I think that, sort of to Nico's point, the core carbon principles create sort of an idea. They help to define that nebulous concept of carbon credit quality. I think that everybody in this market has sort of been chasing in a way. In the last year, you've been able to sort of see this concept evolve in real rapid time, which is pretty cool for people who watch different commodities markets pretty regularly. The speed at which the voluntary carbon markets is really evolving, given all of sort of the new interest and new money piling in all at once, has meant that you're kind of seeing things develop really rapidly, which is pretty neat. But just on the abstract side, but what that means is that you're able to sort of see how this has evolved within the last 12 months, which is an extremely short period of time, typically in sort of market evolution, where in January last year, when Platts first launched its first initial carbon credit price, was for Platts CEC, which reflects CORSIA eligible credits, and there was a lot of concentration around sort of the CORSIA definition because it was the only definition of quality that new entrants to the market could really latch onto. And sort of through the task force and kind of the larger conversations around that and sort of the broad participation in that as well, I think, and a lot of people have become increasingly more aware of different attributes of quality beyond CORSIA. And the conversation has really evolved away from CORSIA being sort of the key thing towards this idea of potentially core carbon principles or potentially to ratings. And so one of, I think, the challenges for the core carbon principles moving forward, given the amount of time that it's taken to come up with them in some ways, is whether or not they can also evolve with the speed with which the market is evolving itself, right? Because there's every chance that the core carbon principles could themselves become outdated within 6 months if you're not constantly seeing the way that the market itself is changing. And that's something that I think is going to be a real challenge, particularly in voluntary carbon, just because of the speed at which it's been evolving recently. And to your point, Paul, earlier about sort of how this is supposed to be a $300 billion market by 2030, I think I got that figure right. Like that is massive growth. I don't necessarily think that, I mean, I don't want to be a pessimist, but it would be, record breaking to achieve that. So I'm not sure if that will hit, but regardless, the amount of interest, I mean, the markets themselves have been growing exponentially, within the last 18 months. And while the energy crisis and sort of the Ukraine-Russia war has caused a bit of a setback in that regard, it hasn't necessarily caused a full-scale stop by any stretch of the imagination. It's caused a little bit of a hiccup, but they're growing again, just not quite as fast. And so I think that, that means that this whole concept of how we define everything and is going to continue to evolve. And so any sort of approach that you take from benchmarking, any approach you take from sort of defining quality needs to be able to evolve with the times, because it is about market mechanisms, and the market will decide, and the market is constantly kind of changing and evolving all the time. And so nothing is going to really be set in stone. And I think that it'll probably be a good few years before it is, if it ever is.
Right. Now, Raúl, I'm going to take Paula's point a step further and say, I will push back and say there does need to be, I would argue, one constant in all of this, in this constantly evolving market, right? Well, it's the accounting standards, right? So, and again, you can argue the accounting standards can evolve with times, but to have that anchor that is consistent global accounting policy that can be flexible enough to adapt to the change that Paula implied. For me, that seems just like a no-brainer first step, that you have to get there before you can actually have the benefits of growth, et cetera, that Paula alluded to. How do we get to that place of uniformed accounting standards where accounting bodies across the globe actually agree on this should be on the one singular approach?
Well, no, that's a good question. Well, the first thing I would say is that in order to do that, what they have to do is, on the side of the International Accounting Standard Board, is to set up this as a priority, because it is not a priority at the moment. They have set aside this kind of research on the side of regulatory bodies and accounting bodies. This is not a priority at all. And that's the point is, first of all, to say, well, this is a priority. We need to tackle this now instead of setting this aside. Regardless, this kind of very nice International Sustainability Board appointed last month of November. And that's one thing, the priority in working on this. And the second thing is to revisit the concept of financial instruments and fair value criteria. This is something very, very concrete. And I'm going to explain why. Under the IFRS, a financial instrument is a contract that gives rise to a financial asset, of one company, and a financial liability or equity instrument of another entity. This is according to the IAS 32, International Accounting Standard 32. So, and as at present, a spot carbon asset would not comply with the financial instrument definition of IAS 32. And that is why it is accounted for as inventory or intangible assets for now. And this is a big mistake. So all financial institutions, non-financial institutions are claiming for this, and they cannot speak below there, to be honest. So financial assets, according as well as IAS 32, included for trading category and therefore measured at fair value. We are talking about something very technical, but we need to talk about that. So measure at fair value through profit or loss are financial instruments. And there are three categories why they are considered as financial instruments: acquire or incur principally for the purpose of selling or purchasing them in the near term, and so on. There are more. So, and for instance, also in the case of carbon assets, when they are managed by a bank for its clients, meet this whole definition. So the point is why they are not treated as financial instruments. So the point is, on the side of regulators, they need to tackle this issue seriously as a priority. Again, this is not a priority. I can explain very well the agenda from the 2005, 2015, 2022 in the previous year, and why in the third consultancy group they have set aside this kind of to tackle the issue of carbon markets on the side of the ISB. They set aside, saying this is not a priority. We don't have resources for that. This is the situation. And again, we need to revisit this, because the point is that at the moment what's going on is that local regulators worldwide, they are all applying their criteria. And this is, to be honest, this is a mess. We need a standardized global standard for this. Again, turning to the point of financial instruments, revisiting this, and financial assets according to the IAS 32. And to tackle seriously the reporting and the accounting on the liability and asset side of these carbon offsets.
Got it. Raúl, we've got 5 minutes to go, but I want to ask one quick question before we get into the concluding thought. If we are retiring credits, right, and then there's an active school of thought that if you're going to buy a credit against an emission, you should retire that credit, right? How do we account for the retirement of credits?
As inventories. At the moment, as inventories. Exactly.
Right. So on the balance sheet, they would just simply offset against an emission.
Exactly. And to be even more specific, Paul, for instance, if the emission rights are awarded or acquired for consumption in the company production process, they will be classified as intangible assets in that case. And when they are sold, as inventories. This is how it is at the moment.
Got it. Sorry, Raúl, sorry, please.
Yes, just something very important is just to think about. If there is no time, we will not talk about that, but the consumption of regulatory capital is extremely painful for carbon offsets right now. And we are in the last phase of the implementation of the fundamental review of the trading book with Basel III, as you know, Basel IV coming up in January 2025, and the high risk weights of carbon certificates. This is what we have at the moment. And they have allocated a risk weight bucket of 60%, which is among the highest of all commodities, almost twice of crude oil. And the current positions are penalized as well, meaning that buying spot and selling forward entails a capital charge.
Raúl, I know you've, sorry to interrupt, we've only got a couple of minutes left and I want to get to one more thing, but I know you have written a paper on this, and when you're ready to publish that, we'll pop it up on the side. Everyone, just before we leave, can I get one improvement that you would like to implement now that we can simply implement that would improve transparency in VCM? Nico, I'll let you go first.
Yeah, I'll just go for, like the registry publishing transaction and transaction prices. I mean, that would help for everyone to see at what price things trade. Could be registries, could be something central, but something that helps us see transaction prices like we see on exchanges.
Got it.
But on the stock market.
Marcelo.
Or potentially maybe I'm thinking doesn't have to be live, but it could be at the end of the month or end of the quarter, as you see in certain cases for some compliance market, for example, in California or other markets, you see that as well. So.
Got it. Marcelo.
I would see a unification of the registry information on some sort of meta registry would make information transparency and information asymmetry, which exists a lot in projects today, basically a lot more tangible and a lot easier to handle.
Got it. Raúl, your last thought. What would one thing you would implement?
I would ask the IASB to set up a team to work seriously on this project and to come out with a solution for not only for the reporting but for the accounting of carbon offsets as a priority, and also to revisit the definition of financial assets and financial instruments in the accounting framework.
Great. And Paula, we'll leave the last word to yourself.
Well, I was going to say meta registry, but since Marcelo covered that, what I'm actually going to say is I think that the fixation on fixed price transactions, so flat price transactions, is actually potentially a big shortcoming to being able to effectively grow the market. And I think that that's sort of historical, but I think in order to kind of transition away from this purely spot market indication towards something where you have long-term financing and long-term deals going on, you're going to have to move away from sort of this flat price basis because that's too much risk for any single party, whether you're a developer or whether you're a buyer, to really take on. And I think that I mean, not to plug our own work, but I think that really, it makes sense to move towards a benchmarking system rather than focusing on this sort of flat price transaction. And that is going to be, again, that's a big paradigm shift, I think, for this market to kind of wrap their heads around at the moment. But we're getting there.
Well, I think that was one of the more ringing endorsements for futures markets that I've heard in a while. It is, the development of forward curves are so vital.
I'm an econ person. What can I say? Sorry.
Everyone, thank you very, very much. We're up against time, but these conversations could go on for hours. Paula, Nico, Marcelo, and Raúl, thank you very much for your time. Everyone, stay tuned. We've got more coming up. We've got my panel on resource sovereignty coming up in about 5 minutes. So, everyone, thank you very much.